We have not seen that in the precious metal space. It's a highly unusual situation where the companies are starting to cash flow tremendous amounts of profit margins of free cash flow here. The large and mid-cap producers are starting to make a heck of a lot of money. Yet there's very little interest in buying those stocks, and even less interest in buying the small mid-cap, micro-cap stocks that I'm heavily involved in as well. So yeah, the yet in that sentence is key. What's been happening, Andy, is, the market's been really, really strong the last couple of years. The Magnificent Seven, the tech stocks, the NASDAQ has really been a place where investors can basically close their eyes, buy 7 stocks, and make a ton of money. It reminds me of the late 1990s during the dot-com boom. You bought the dot-coms, you bought the big tech stocks, and you could just make money hand over fist. So if you're making money so easily in the biggest, most liquid stocks in America, there's not a lot of interest for investors to rotate down to other sectors. I'm very hopeful. I'm very confident that, like you said, 2025 is going to be the year for a few reasons. One, the fundamentals dramatically improved for the industry. So the company's margins are actually going up. They're actually generating a lot of free cash flow. The profitability is going up. Sector-wise, the gold sector probably has the best year-over-year comparisons in terms of earnings and cash flow and outlook for any sector in the market. So that's going to start to attract the average generalist attention in 2025. And, we're only, 10, 15 days into the new year so far, but so far this year, the market's kind of stumbled out of the gate. So the S&P is down this year, the NASDAQ's down this year. I checked on Friday, the GDXJ is up 6%. So when you start to see the gold stocks outperforming the indices, and if you even see if tech or the NASDAQ or the S&P 500 just goes sideways, flat to down in 2025, and gold stocks continue to go up, you're going to start to see rotation of capital to the industry. And the gold sector is so small, Andy, a small percentage of people selling 1% of their tech stocks portfolio and moving into gold could have these stocks up 50, 100, 200% very, very quickly, because the size of the sector is so small relative to the other indices that any fund flows into the sector will drive a big impact. And we have not seen any fund flows into the gold sector from an institutional investor perspective, probably since March 2021 in the pre-COVID period. So that's why I'm so positive. The fundamentals are fantastic. The valuations are very, very low. I think the stage is set for the gold sector to outperform on a stock market return basis the rest of the market, and that'll attract more fund flows and attract more eyeballs on our space. And these stocks would all be primed to have some significant rise in the back of that.
So that's a really good answer. And there's two things that, I guess, two different situations in the past 25 years, and I've been doing this a long time. The first one was 2000, as you mentioned, when the tech boom, the NASDAQ started really correcting there. I was in the market. That's a long story. But what was interesting to me is how gold, and correct me if I'm wrong, the gold and gold stocks really significantly outperformed. In fact, did very, very well during that time. The opposite of that is 2007, 2008, when we had the credit markets completely contract, if not, it just really just seize up. What would it be? I mean, obviously your take is of the latter, but how could you see again another correction like we had in 2007, 2008? Because that's really my fear here, if you would, at this moment, even though I don't think it's going to happen. Does that make sense?
Yeah, it's a great question. I would say yes. There's two scenarios. And I think your viewers have to remember that when the stock market crashes, and we're talking about a crash, I'm not talking about a down 5%. I think investors have got a bit too greedy and too complacent. They think, oh, market's down 5%, that's the crash. No, a crash is like you saw when the dot-com boom busted in 2001. The NASDAQ was down 80 to 90% from its peak. In 2007, 2008, when the market rolled over in March of 2008, the S&P was down like 50%, 50 from its peak. So in a crash where the stock market is in total free fall or plummeting, gold stocks are gold producers, but they're also stocks. So when every stock in the market is going down 50%, you will have some pain in your portfolio. So I'm not here to say if the market crashes 50% tomorrow, if you own a boatload of gold stocks, you're going to be laughing as that happens. The stocks will go down. But in all those cases, Andy, when the big crashes happened in the dot-com boom or in 2008, if you look, the first stocks to rally out of the crash and the best performing stocks out of the crash were the gold stocks. And why is that the case? Is because typically the response of the government to a major crash is to print even more money. What's unique about this cycle, Andy, is we're printing boatloads of money. We haven't even had a recession or a crash yet. So imagine how much money we're going to have to print if we end up, taking on water and drowning here as a market. So yeah, so you will have, if this market crashes, your stocks will go down like every other stock goes down, but they're probably the best performing stocks on the way out, which is why I'm comfortable holding them into kind of any market environment. The first scenario I talked about was a scenario where the market just sort of rolls over, like, NASDAQ's up 25, 30%, pretty solid last kind of 3, 4, 5 years. if that starts to stop, even if Nasdaq's flat to down 5% for the next couple of years, investors will get bored. They'll no longer be making easy money in the market. They'll say, where can I make some money? And that's where I highlight a big land on the gold sector being probably the best fundamentally driven sector in terms of fundamental cash flow earnings and growth, but also in terms of valuation. So in a scenario where the market's just sort of being stagnant or rolling over slowly, I think the gold stocks will be outperforming and track a lot of capital. In a crash scenario, I think you want to be buying those stocks even more in a crash because you know they're going to be the first ones out of the gate to rally even harder. And that money printing will be adding even more fuel to the fire that's already started in the gold space in terms of a positive backdrop.
Yeah, great answer. Yeah, great answer. So let me ask you this: is what's going to happen in your mind? You said what's going to happen first? Is it going to be institutional money coming into the sector? Is the retail investor going to have to come into this sector? Because you brought up a great point. You haven't seen institutions really come into this sector since 21. Are they starting to come into now? I guess that's a two-part question.
Yeah, we're starting to see it. We're starting to see the bigger names do better. So last year, single asset producers, like Lundin Gold, the Canadian Mining, they had good years. The mid to larger caps like Alamos are having good years as well. So we're starting to see some institutional money come into the space, but it's very cautious money. Andy, it's names that are generating a lot of cash flow with clean balance sheets, but there is some there. They've yet to move down cap. When the investors typically move down cap, when institutions do is they start lagging the indices. So most institutions, if you did a poll of 100 institutions, I bet my kids on them, they're dramatically underweight gold. Most institutions are underweight gold. And so it doesn't hurt them if the Nasdaq's up 30 and the gold sector's up 25. You go, okay, well, I'm not underperforming the market. But let's say like this year, GDXJ is up 6, the market's down 3. Those long-only institutional investors go on gold as part of the index in Canada in a bigger way, and less so in the US, start to underperform their indices due to the fact that they don't own gold, and therefore they're under pressure to allocate more money to the sector to catch up that fall behind performance that they're having. Well, then they'll typically go down cap because down cap, they know they can make bigger returns and catch up faster. So we're starting to see the first wave of just allocation, but when it starts to hurt their performance, you'll see a more of a rush to allocate, and you'll see them moving down cap to catch up on performance-wise. And then retail's the same thing. And if you can make 50% in a day buying Fartcoin, or these other meme coins you're buying in the crypto space, that speculative retail money is less inclined to go seek out other speculative opportunities. So the speculative money has really been caught up in the whole AI and crypto kind of mania space that you have right now. If that rolls over, then that speculative money will want to find a new home. And one of the best places to be, or the best place to be, in my opinion, would be the gold sector. So it's hard to say who's going to come first, whether it be retail or institutional, but that's the path that you see. So I'm seeing early innings of institutional allocation. I'm not seeing the retail interest there yet, despite the record high prices of gold. But as a contrarian investor, I actually like that a lot. That tells me there's a lot of return to come my way. When I see every retail investor I know buying gold stocks, every institution I know buying gold stocks, I probably know we got 3 to 9 months left in the rally. Whereas here, I do see the stage set for a multi-year rally because there's so little participation. There's a lot of buyers yet to come versus that are already on the boat, versus other sectors where the boats are full. There's not many incremental buyers left to drive these, tech stocks or cryptos higher going forward.